You are listening to The Vocal Technologist. Spoken tech for your ears.
If you've been watching the financial tech space lately, it really doesn't just feel like one revolution. It feels like we're watching two of them. You know, these two massive tectonic plates just colliding.
Oh, absolutely.
You've got the rise of AI, which is just everywhere. And then at the same time, this quiet, steady maturation of digital asset infrastructure. It's finally doing real things.
It's finally moving beyond the trading
That
disc.
pace is just, it's blistering.
It really is. And I think our goal today is to really look at the collision point. We need to move past the headlines and see how these things that seem so separate, from global remittances to the bank, back office, how they actually connect. This is about finding those key points of, well, growth and risk that you need to be watching right now.
Okay, let's unpack that. I think the best place to start is where the rubber meets the road, right?
Yeah.
Real world utility. We've been talking about crypto as the future of payments for, I don't know, a decade. But now it's actually happening. The infrastructure is being used to challenge the big players.
Exactly. And look at SoFi. I mean, they didn't just test the waters. They jumped in. They're the first U.S. bank to use the Bitcoin Lightning Network.
And the universal money address system, that's a huge piece of this.
It is. It shows real institutional trust. They're starting with Mexico, and the system, it's powered by Lightspark. It converts dollars to Bitcoin, sends it.
Instantly,
and then converts it back to the local currency. But you're right, that universal money address, the UMA, that's the quiet little revolutionary here.
Because it's a standard, right, like an email address for money. You don't need all the SWIFT codes and routing number.
Precisely. It simplifies the whole destination part of the payment, no matter what rails you're using.
Which puts SoFi in a position to go right after that, $740 billion global remittance market?
That's the number. And with that kind of speed and much, much lower fees, there is serious problem for the MoneyGrams of the world.
And it's not just the regulated banks either. I mean, look at Block, what used to be Square.
Oh, yeah. This is massive.
They're enabling over 4 million merchants to accept Bitcoin payments across all their devices. Starting now.
4 million. Just let that sink in.
It has to be one of the largest real-world crypto payment rollouts ever. And the way they're structuring it is just, it's so disruptive.
It's the economics of it. They're using Lightning, so it's nearly instant, super low cost, and then Block is just waiving all the fees until 2026.
And after that, it's what, 1%?
Just 1%. I mean, that's not just a low fee. That's a declaration of economic war on the traditional payment gap.
Yeah, it is.
What's so fascinating is we're seeing this strategic shift. Crypto isn't just a speculative thing anymore. It's being used as a utility layer. The only reason they can charge 1% is because Lightning just goes around all that old legacy banking infrastructure.
The very same infrastructure that demands that 2.5% interchange fee.
Exactly.
It's a classic David versus Goliath strategy, and it feels like Goliath is starting to flinch. Which brings us right to that huge Visa and MasterCard settlement.
They absolutely felt the pressure. They had to. So they've agreed to cut those interchange fees.
By just a little bit, right? 1/10 of a percentage point or so?
Right. It's not a huge cut.
Right.
But the bigger deal is they're letting merchants reject certain cards now.
Ah, the really expensive ones. The high reward premium cards.
Those are the ones. It gives smaller businesses actual cost control, maybe for the first time in, well, a very long time.
So on one hand, you have this crypto utility layer putting pressure on pricing. But now let's talk about the other force, the one that's going to completely rewrite the rules. AI.
Right.
It feels like we are walking right into the age of agentic commerce.
That's exactly the right way to frame it. It just means a future where our software agents, our AIs, are making payments on their own. Computers paying other computers.
With no human in the loop.
Zero. And for that to work, you need new protocols. You need machine-to-machine payments baked into the web itself.
Which is where Coinbase comes in with this new Buy 402 protocol. And I just love the name. You know, everyone knows error 404 not found. They're betting that 402, payment required, is about to become just as common.
The idea is just brilliant in its simplicity. It injects stablecoin payments directly into web traffic. So every time a program requests data, that request can carry a tiny automatic paywall.
That an AI agent can just clear instantly. It's making payments a native part of the internet again.
Yes, a fundamental architectural change.
And of course, at the same time, Visa is playing defense again, not just on price, but now on trust. They're introducing a trusted agent protocol.
They see the writing on the wall. If transactions are autonomous, they're also vulnerable to, bad bots.
Right.
So their intelligent commerce suite is all about using things like tokenization to create safeguards. It's to make sure that when an AI shops for you, the merchant knows it's a legit, authorized bot.
So if we pull back, the big picture here is that payments are becoming invisible. They're becoming automated, controls kind of shifting away from the human user.
It is. But AI isn't just changing the front end. It is completely transforming the infrastructure behind the payment. That's where banks are feeling the biggest shift.
I mean, you look at JP Morgan's own forecasts, and it's all there in black and white. They see AI reshaping the bank in a really uneven way.
Totally uneven. They think front office jobs, like sales and investment banking, will actually grow.
Because AI is like a super assistant for them.
Exactly. It frees them up for high-level strategy, the middle office, risk and compliance. They get a huge productivity boost from automation.
Yeah.
But the back office, that's where the pain is.
IT, settlements, HR.
That's where they're projecting the steepest cuts. Their own executives are talking about up to a 10% reduction in operations staff.
Hang on, a 10% staff cut seems ambitious, even for AI. Aren't they also creating a ton of new, complex compliance risks that need human oversight? Who's supervising the AI?
That is a fantastic point. It's true, AI does create new jobs, but those jobs often need a totally different, much higher skill set than the jobs being automated away.
So it's not a one-for-one swap.
Not at all. That 10% number reflects getting rid of repetitive rules-based work. The efficiency gain is real, but it definitely favors high-skill workers. We're moving from a do-it-with-you model to a do-it-for-you agentic AI model.
The power of that efficiency is just staggering. I actually touched on something similar on my show, The Vocal Technologist, when we're talking about fully autonomous agents. The example of Built Technologies in real estate lending is perfect here.
Oh, Built is a great example. They use an AI agent for commercial real estate draw requests. So that's when a builder needs the next chunk of their loan money.
Which is usually this slow manual process of checking documents. It takes days.
And their AI does it up to 95% faster.
And the ROI is it's jaw-dropping. We're talking 300 to 500% in the pilot programs.
Right, because you're taking a process that took days and shrinking it to minutes. That 500% ROI isn't just a number on a slide. It fundamentally changes the staffing math for every bank in that business. Humans just handle the exceptions.
So all of these innovations, these lightning-fast payments, this autonomous AI, it's all happening while there's this huge institutional maneuvering going on, and at the same time, growing pressure on consumers.
That's the backdrop to all of this.
Let's shift to that. Let's look at where the institutional money is going and then the reality of consumer debt.
Well, institutionally, the money is just flooding into this foundational infrastructure. Ripple just raised $500 million.
At a $40 billion valuation.
A $40 billion valuation. And they're expanding way beyond just cross-border payments. They're into stable coins, asset custody, corporate treasury. They want to be the essential utility for big finance.
And the traditional guys aren't just sitting there either. Charles Schwab is buying Forge Global for $660 million.
Which is a huge push into the private markets. It tells you their big clients want access to pre-IPO shares, to assets that aren't on the public stock market.
So on one side, you have these massive valuations, exclusive wealth creation for institutions and the rich. And then you look at the average consumer.
And it's a totally different world. A very stark picture.
Americans now owe a record $1.23 trillion on credit cards.
Trillion? With a T. The average balance is over $6,500.
That is the K-shaped economy right there. In sharp relief, the top half gets private market access, the bottom half gets record debt.
And experts are warning that high interest rates and flat wages are just making that divide deeper and deeper.
So how is consumer fintech responding to all this stress?
They have to respond directly. Current is a great example. They built their own banking core from scratch.
Which lets them do things like early paycheck access and overdrafts with no fees.
And it's working. 70% year-over-year revenue growth. They're building for people who are really living paycheck to paycheck.
And even the big traditional banks are having to adapt. U.S. Bank just rolled out this really interesting split card. It's basically their answer to buy now, pay later.
It is. It's a MasterCard that just automatically splits every single purchase you make into 3 equal monthly payments.
Interest-free.
Interest-free. It's a pragmatic move. It gives you the feel of a credit card. But with that structured budgeting that younger consumers especially are looking for, it's them admitting that the old revolving credit model just isn't working for a huge part of the population.
So when you put it all together, what does it all mean? You've got this incredibly sophisticated tech making everything faster and cheaper for institutions. But that speed and efficiency is just colliding head-on with this worsening personal debt crisis for regular people who are now relying on these new affordability products just to get by.
And that raises a really important question for you to think about. As all this agentic AI and ubiquitous crypto makes spending faster and cheaper for the big players, who is helping the consumer manage the debt that the same technology makes so incredibly easy to accumulate?
That's a good question.
If AI makes spending seamless, if it removes all the friction, what structures do we need to put in place to make sure financial health doesn't just get worse under the weight of that $1.23 trillion balance? It's something to really mull over as you watch all of this unfold.
A truly challenging thought for the year ahead. Thanks for joining us for this look at the collision of AI and fintech. Go explore the material, and we'll catch you on the next one.
Spoken Tech for your ears.